Silver just hit a new all-time high above $67. Is $70 coming next? Silver reaches a new all-time high. Silver has once again rewritten the record books, surging above the $67 level and marking a new all-time high. This move is not merely another short-term spike driven by speculative enthusiasm. It represents a culmination of forces that have been building across multiple years. Unlike past rallies that often faded quickly, the current breakout carries structural significance, reflecting a deeper shift in how silver is being valued by both financial and industrial markets. What makes this milestone particularly striking is the broader context in which it occurred. Precious metals as a whole have been strong, with gold also pushing into record territory, yet silver's performance stands out for its intensity and speed. While platinum briefly outperformed silver on a percentage basis during parts of the session, silver remains the focal point of attention due to its dual role as both a monetary and industrial metal. This duality amplifies its volatility, but also enhances its long-term relevance. Crossing $67 is symbolically powerful. For decades, silver was often viewed as the laggard among precious metals, highly volatile, prone to long consolidation phases, and perpetually overshadowed by gold. Breaking decisively into record territory challenges that narrative. It signals that silver is no longer simply reacting to gold's movements, but is increasingly being driven by its own fundamentals. The narrowing of the gold-to-silver ratio below 65 reinforces this shift. Historically, such compression has occurred during periods when silver begins to outperform gold, often late in precious metal bull cycles. Investors tend to rotate into silver when confidence grows that inflation risks, currency debasement, or supply constraints are not transitory. In this sense, silver's new high reflects not just price momentum, but a change in conviction. Another important aspect of this record is timing. The rally unfolded heading into the holiday period, traditionally a quieter time for markets due to lower liquidity and reduced participation. Instead of fading, silver accelerated. That resilience suggests strong underlying demand rather than a thin, easily reversible move. When prices rise in spite of seasonal headwinds, it often indicates that larger forces are at work. Psychologically, new all-time highs matter. They remove historical resistance levels and force market participants to reassess valuation frameworks. Without obvious chart ceilings, price discovery becomes dominant, and sentiment shifts from skepticism to acceptance. While this does not eliminate the possibility of pullbacks, it changes the nature of those pullbacks, from signs of failure to potential consolidation phases within a broader uptrend. Ultimately, silver's breakout above $67 is less about celebrating a number and more about acknowledging what that number represents: tightening physical markets, sustained industrial demand, and a macroeconomic backdrop that increasingly favors hard assets. The move confirms that silver has entered a different phase, one where it is being repriced rather than merely traded. Price action and market metrics. The technical and statistical dimensions of silver's rally provide crucial insight into why this move carries weight beyond a single trading session. On the day of the breakout, silver gained more than 2.6%, adding roughly $1.70 per ounce, and pushing decisively into new record territory. Intraday volatility was significant, yet the market demonstrated an unusual ability to absorb selling pressure and recover swiftly. One of the most telling metrics was the intraday range. Silver experienced a sharp pullback early in the session after surging toward the mid-$66 level, falling rapidly toward $64 amid heavy volume. Such moves are often interpreted as smackdowns or liquidity hunts, where large players test the market's depth. What followed, however, was far more important than the sell-off itself. Buyers stepped in aggressively, driving prices back up and ultimately through previous highs. Volume patterns reinforce this interpretation. Early trading saw strong participation, typical of institutional activity during the most liquid hours. After the initial correction, renewed buying interest emerged later in the session, even as overall volume tapered during midday. A late-day resurgence in activity pushed prices higher once again, underscoring persistent demand rather than fleeting speculation. The gold-to-silver ratio is another critical metric. At approximately 64.6, the ratio has fallen to its lowest level in years. This compression is not simply a function of gold weakening. Gold prices have also been strong. Instead, it reflects silver's relative outperformance. Historically, when the ratio falls below key thresholds, it signals that investors are increasingly comfortable with silver's volatility in exchange for its higher beta exposure to macro trends. Psychological price levels play an outsized role at this stage. The $67.50 area represents not just a round number resistance, but a zone where profit-taking naturally emerges after a rapid ascent. The fact that silver traded comfortably near this level, even after sharp intraday swings, suggests that the market is beginning to accept higher prices as the new normal. Attention has now shifted to the $70 threshold, a level that carries both symbolic and technical importance. It is also worth noting the broader precious metal complex. Platinum's strong performance and gold's record highs create a supportive environment for silver. Cross-metal correlations matter because they influence portfolio allocations. When multiple metals perform well simultaneously, it reinforces the perception of a sector-wide revaluation rather than an isolated anomaly. From a technical perspective, silver has transitioned from a breakout phase into early price discovery. Traditional resistance levels derived from historical charts lose relevance once all-time highs are surpassed. Instead, traders rely on momentum indicators, volatility measures, and intermarket signals. In such environments, pullbacks tend to be sharper but shorter, as buyers view dips as opportunities rather than warnings. Another key metric is volatility itself. Elevated volatility often deters conservative investors, yet in this case it has coincided with rising prices. That combination suggests strong conviction. Markets that rise while volatility increases are typically driven by fundamental reassessment rather than complacency. In summary, silver's recent price action reflects a market under active repricing. The combination of strong volume, rapid recoveries from sell-offs, ratio compression, and sustained momentum paints a picture of demand overwhelming supply, at least for now. These metrics do not guarantee uninterrupted gains, but they strongly indicate that the rally is grounded in more than technical noise. Market momentum and short-term outlook. Market momentum is ultimately a reflection of collective belief, and silver's recent performance suggests that belief is strengthening. Momentum is not just about prices moving higher, it is about how markets respond to setbacks. In silver's case, every meaningful dip over recent sessions has been met with renewed buying interest, reinforcing the perception that downside risk is increasingly limited in the near term. Short-term sentiment has shifted markedly. Where skepticism once dominated discussions of silver rallies, optimism is now more prevalent. This does not mean that caution has disappeared, but it does indicate that investors are more willing to stay engaged despite volatility. The expectation that silver could test $70 before year-end is no longer seen as fringe speculation, but as a plausible scenario, contingent on continued momentum. Holiday seasonality adds an interesting layer to the outlook. Historically, precious metals often experience subdued trading volumes toward the end of the year. Reduced liquidity can exaggerate price moves in either direction. In this case, however, silver has defied expectations by maintaining strength. That resilience suggests that buyers are not merely short-term traders exploiting thin markets, but longer-term participants positioning ahead of anticipated developments. Momentum is also being reinforced by comparative performance. As silver outpaces gold on a percentage basis, it attracts attention from investors seeking higher returns within the precious metal space. This rotational behavior can become self-reinforcing. Outperformance draws inflows, which in turn sustain momentum. That said, momentum cuts both ways. Sharp advances increase the likelihood of corrective phases, especially when prices move far above short-term moving averages. A pullback of several dollars would not be unusual or necessarily bearish in this context. In fact, consolidation could help establish stronger support zones and extend the life of the broader trend. Short-term outlook must also account for macro catalysts. Upcoming economic data releases, central bank communications, and geopolitical developments can all influence sentiment rapidly. Silver's heightened sensitivity means that reactions may be amplified. However, the market's recent behavior suggests that bullish interpretations are currently favored. Technically, the absence of overhead resistance means that momentum traders will continue to play a significant role. Breakouts into uncharted territory often attract algorithmic strategies designed to follow trends rather than predict reversals. This dynamic can sustain upward pressure longer than many expect. In the near term, the key question is not whether silver will experience volatility. It almost certainly will, but whether that volatility resolves higher or lower. Current evidence points toward higher resolution. Each attempt to push prices down has been met with buying strength, indicating that the market is comfortable absorbing supply at elevated levels. Ultimately, momentum is a fragile thing, dependent on confidence. For now, that confidence appears intact. Silver's short-term outlook remains constructive, with the balance of risk skewed toward further upside as long as the underlying drivers remain in place. Physical silver market conditions. One of the most misunderstood aspects of silver's rally is the state of the physical market. Headlines often alternate between claims of severe shortages and assurances of ample supply, creating confusion among investors. The reality lies somewhere in between and varies by segment of the market. There is no universal shortage of silver at the wholesale level. Large bullion dealers continue to source material, and refined silver remains available for delivery. However, availability does not equate to ease. Tightness has emerged in specific products, particularly retail bars, rounds, and coins, where premiums have widened significantly. These premiums reflect not just metal scarcity, but logistical constraints, fabrication capacity, and surging retail demand. Vault activity provides further insight. Substantial quantities of silver have reportedly left futures exchange vaults, including those associated with COMEX. While this does not imply imminent default or depletion, it does indicate that metal is being mobilized to meet demand elsewhere. Such movements reduce the buffer available to absorb future shocks. Internationally, price differentials have widened between Western and Asian markets. Elevated prices in China have prompted discussions of arbitrage opportunities, particularly involving the Shanghai Gold Exchange. When silver trades at a premium in one region, it incentivizes physical flows that can tighten supply in others. Retail investors often feel the impact of these dynamics most acutely. While spot prices may suggest abundant supply, the reality at the coin shop or online dealer can be different. Delays, allocation limits, and higher premiums contribute to the perception of scarcity. These conditions, in turn, reinforce bullish sentiment, as physical buyers interpret tightness as confirmation of underlying stress. It is also important to distinguish between paper and physical markets. Futures and derivatives can reflect large volumes of trading without immediate physical settlement. When physical demand increases simultaneously, tensions can arise. Rising premiums are often the first visible sign of such stress. Importantly, physical tightness does not need to reach crisis levels to influence prices. Even modest constraints can have outsized effects when sentiment is already bullish. In silver's case, physical market conditions are acting as a supportive undercurrent rather than the sole driver of the rally. From a strategic perspective, these conditions favor long-term holders. Physical silver held outside the financial system offers insulation from market dislocations and premium volatility. At the same time, those seeking to acquire new positions must weigh the cost of elevated premiums against the risk of waiting. In essence, the physical silver market is functioning, but under strain. Supply exists, but it is less flexible than many assume. As demand continues to rise, especially during periods of heightened uncertainty, that inflexibility becomes increasingly relevant to price formation. Macroeconomic and monetary policy factors. Silver's ascent cannot be understood without examining the macroeconomic backdrop, particularly the evolving stance of monetary policy. Recent U.S. inflation data showed the slowest pace of core consumer price growth since early 2021, reinforcing expectations that the era of aggressive tightening is behind us. For precious metals, this environment is inherently supportive. Lower inflation reduces the urgency for restrictive policy, while still leaving real interest rates vulnerable to decline. Silver, like gold, does not yield income, making it sensitive to changes in opportunity cost. When yields fall or are expected to fall, non-yielding assets become more attractive. The role of the Federal Reserve is central here. While recent rate cuts have already occurred, forward guidance remains deliberately ambiguous. Market-based probabilities suggest a relatively low chance of immediate additional cuts, but expectations extend beyond the next meeting. Investors are increasingly focused on the medium-term trajectory rather than near-term pauses. Uncertainty itself is a catalyst. When policy signals are mixed, markets often hedge against potential missteps. Silver benefits from this hedging behavior, particularly as concerns about fiscal sustainability and debt dynamics persist. Employment data adds another layer of complexity. While headline figures remain resilient, underlying trends point to cooling momentum. Slowing labor markets can reinforce expectations of accommodative policy, even if official rhetoric remains cautious. For silver, these dynamics contribute to a favorable macro narrative. Global monetary conditions also matter. Central banks worldwide are navigating similar trade-offs, balancing inflation control against growth risks. Synchronization of easing cycles tends to amplify the impact on hard assets, as currency debasement concerns extend beyond a single jurisdiction. Crucially, silver's macro appeal is not solely tied to inflation fears. It also benefits from reflationary expectations, where growth slows but policy support remains. In such scenarios, industrial demand remains intact while monetary tailwinds strengthen. In this sense, silver occupies a unique position. It can perform in both inflationary and disinflationary environments, provided policy responses are supportive. This flexibility enhances its attractiveness relative to assets with narrower use cases. Overall, macroeconomic and monetary factors are not acting as isolated triggers, but as a reinforcing backdrop. They provide the conditions under which supply constraints, industrial demand, and investor sentiment can exert maximum influence. Geopolitical and systemic drivers. Geopolitics has reemerged as a powerful driver of precious metal demand, and silver is no exception. Heightened tensions across multiple regions have increased demand for assets perceived as stores of value outside the traditional financial system. Recent developments in energy-producing regions have been particularly influential. Sanctions, blockades, and military posturing introduce uncertainty into global supply chains, affecting not only commodities like oil but also broader market confidence. In such environments, silver benefits alongside gold as investors seek diversification. Systemic risk extends beyond geopolitics. Concerns about sovereign debt levels, fiscal discipline, and financial market stability contribute to a generalized sense of unease. Silver's relatively small market size amplifies its response to these fears, resulting in outsized price movements. Unlike gold, silver's geopolitical appeal is intertwined with its industrial relevance. Disruptions that threaten manufacturing or energy infrastructure can simultaneously increase demand for silver while constraining supply. This dual impact magnifies its sensitivity to global events. Currency dynamics also play a role. Geopolitical stress often weakens confidence in fiat currencies, especially when combined with expansionary fiscal policies. Silver, priced globally in dollars, becomes a hedge not just against inflation, but against currency volatility itself. Importantly, geopolitical drivers tend to operate on longer time horizons than daily trading narratives suggest. Conflicts and tensions rarely resolve quickly. As a result, the premium they add to precious metals can persist, providing a sustained tailwind rather than a one-off boost. In the current environment, silver is increasingly perceived as part of a broader resilience strategy. Investors are not merely reacting to headlines. They are positioning for a world characterized by fragmentation, competition, and uncertainty. This shift in perception is subtle but profound. When silver is viewed through a systemic risk lens rather than as a speculative commodity, its valuation framework changes. Price becomes less about short-term cycles and more about long-term insurance. Supply-demand imbalances and industrial demand. At the core of silver's rally lies a persistent imbalance between supply and demand. Global mine production has remained largely flat for years, with incremental increases insufficient to offset growing consumption. Unlike gold, much of silver production is a byproduct of other metals, limiting the industry's ability to respond quickly to higher prices. Demand, meanwhile, has diversified and expanded. Industrial applications now account for a significant share of total consumption, driven by technologies that are integral to modern economies. Solar energy alone consumes substantial quantities of silver, with each panel requiring measurable amounts of the metal. Electric vehicles, electronics, and data infrastructure further reinforce this trend. As societies electrify and digitize, silver's conductive properties make it difficult to replace. While research into substitution continues, viable alternatives at scale remain limited. These industrial uses are not easily curtailed during economic slowdowns. Many are tied to long-term policy goals, such as energy transition and technological advancement. As a result, silver demand exhibits a degree of resilience that challenges traditional commodity cycles. The result is a market where deficits are structural rather than cyclical. Inventories can bridge gaps temporarily, but sustained drawdowns eventually influence prices. Recent reports of declining visible stocks underscore this point. Crucially, investment demand is now layered on top of industrial demand. When both sectors compete for the same limited supply, price pressure intensifies. This convergence distinguishes the current environment from past rallies, driven primarily by financial speculation. In this context, silver's price is less about exuberance and more about arithmetic. Limited supply growth facing expanding demand inevitably leads to higher equilibrium prices over time. Long-term perspective on silver. Taking a step back, silver's extraordinary performance this year, up roughly 130%, demands perspective. Such gains are exceptional and unlikely to repeat annually. Yet focusing solely on returns risks missing the broader story. Silver's true value lies in its role as a long-term store of purchasing power and strategic asset. For thousands of years, it has served as money, a medium of exchange, and a hedge against uncertainty. Modern markets may express these functions differently, but the underlying logic remains intact. Viewing silver purely as an investment can be misleading. Prices fluctuate, sometimes violently, and timing is notoriously difficult. A more durable approach is to see silver as part of a diversified strategy, one that prioritizes resilience over speculation. Corrections will occur. Volatility is inherent. But these features do not negate silver's relevance, they define it. Holding a core position through cycles allows investors to benefit from long-term repricing, without being whipsawed by short-term noise. Ultimately, silver's resurgence reflects a rediscovery of its fundamentals. As monetary, industrial, and geopolitical forces converge, the metal is being reassessed, not as a relic but as a vital component of the modern economic landscape. In that sense, silver's new all-time high is less a destination than a milestone along a longer journey.